Hello everyone, this is Charting Man Dan of TheChartGuys.com, and in this video we're going to be going over an introduction to technical analysis, and it's going to be designed for those of us who are just dipping their toes into the vast world of charts and technical analysis. And every single trader that utilizes technical analysis at one point in time was very brand new to everything, and everything seemed overwhelming. We know there is tons of information out there on the internet which should certainly be utilized, but it's important that we stay organized and don't get overwhelmed and be able to direct our focus and our education to learn what is most important and then be able to apply it in the real world to become more profitable traders and investors. So what we're going to be going over today is the lesson outline here, the basic chart elements, what we are looking at when we see all those candlestick shapes and all the lines on the charts. We've got volume we're going to look at because that's important for knowing how much dollar volume is being traded. And volume basically is just the amount of shares going back and forth, but there's lots of information that you can gather from that volume data. Moving averages, what they are and how they can be used in your trading game plans. Trends, just the basic overall, what makes an uptrend and what makes a downtrend. And even if you're not going to be a full-time trader, and even if you're not going to trade often, being a long-term investor, knowing trends is very important. And that's why I think it's essential for pretty much everybody that has anything to do with this market needs, I'd say, at least a basic bare minimum of a dozen hours of education to be able to look at a chart and know my stocks, my long-term picks are in an uptrend or they're in a downtrend, and I should get out of these positions and find stocks that are in a bullish long-term uptrend. Next, we'll look at indicators, and these are tools that traders have in their tool belts, the RSI and some other things that make trading a little bit easier in terms of giving us other information, overbought and oversold conditions. And then we'll look at candlestick psychology because that's what charting is. It is plotting emotion, human emotion and psychology in a pictorial form here on a chart, and being able to utilize that information to stay one step ahead of the herd, so to speak. And I refer to the herd as basic retail traders who are behind the curve a bit, so to speak, without using technical analysis. So let's get right into it and look at basic chart elements. So before we get into the basic candlestick representation of what we're looking at on a chart, I want to get into what I find very interesting here, and it's the history of Japanese technical analysis candlestick trading. It originated back in Japan in the 1600s, and the fact that we are using this information and this trading style 400 plus years later, I find that extremely fascinating. And the reason that that does work is due to the consistency of human emotion. And again, that's what's depicted on these charts, and being able to capitalize on exuberance in traders, over exuberance when we're going to the upside, and greed, and being able to capitalize on fear and panic is definitely what these charts are trying to represent to us. And like I said, that human emotion does not change through time. It certainly hasn't in the past 400 years. It worked back then, and it certainly works now, as you will see. If you keep diving into technical analysis and sticking with it with motivated educational game plans, you will certainly find for yourself that it is more useful to utilize this information than it would be to completely ignore it. So the birth of technical analysis, back at this time period, you'll find that a lot of the terminology in these technical analysis candlesticks, the names of the candlesticks, and it's a lot related to war, and that's due to the culture at the time. It was a samurai-based culture, and there's a lot of war strategy, and it's really looked at trading as a battle plan, so to speak. And it was utilized most in the rice markets. There was a man named Hamna, and he was known as the god of the markets. He dominated the trading industry because he developed and utilized, he was one of the developers of technical analysis, and being able to see the chart and the trading action visually certainly gave him a step up on the competition, and it showed by the amount of wealth that he was able to amass. So it was used in Japan for hundreds of years. It didn't make its way to the U.S. markets until about the 1970s. So all in all, it's fairly new to the U.S. markets. 40 years certainly seems like a long time, but when you're talking 400 years back in Japan, you can see that we're a bit behind the game here in the U.S. But you can see that it is certainly catching on. A lot of traders are utilizing it, and it's becoming more and more popular as more and more people see the benefits of this trading style. So let's look now at what a basic chart is and what these candlesticks represent. So this is known as the real body of a candlestick, and it's the solid part, and then you have the wick, the upper wick, and then the lower wick, and the lower wick is sometimes referred to as a tail. But what it tells us when the candlestick is green, and the color of these candlesticks is important, But when it's green, we have the open of the day. If you're looking at the daily chart, these candlesticks represent whatever time frame you're looking at. So if you're on a daily chart, this is one trading day worth of action. If you're on a weekly chart, 1 week worth of action. And if you're zoomed all the way into a 1 minute chart, a candlestick can represent 1 minute of trading. So if it's a green candlestick, you have the open at the low of the real body and the close at the high. And then the range of that trading period is shown in these wicks. You have the low of the day if it's a daily chart and the high of the day. Now, why the color is important, because you can see these two candlesticks look exactly alike, but depending on the color, that's going to tell you where the open and the close are. The high and the low are going to be the same regardless. It's always the top and the bottom of the wicks. But depending on the color of the candlestick, it's going to determine where the open and where the close of whatever time period you're looking at is. So you can see the open here, and we closed lower, so it's a red candlestick because the price went down on the day. So the wicks are the high and the low. The real bodies show you the open and the close. The color indicates that. And the time frames, there are pretty much infinite time frames you can be looking at. The 1 minute, 2 minute, 5 minute, 10 minute, hourly, all the way up to daily, weekly, monthly, yearly, so on and so forth. So let's now look at a chart and see some examples of what these candlestick shapes can tell us. So here we have a daily chart of SPX, which is the S&P 500, and because it's the daily chart, I know that each candlestick represents 1 full trading day of action. If this was the weekly chart, I would know that each candlestick is 1 week, but we're looking at the daily chart. So what we can see from these candlesticks, there are dozens and dozens of shapes, and the shapes indicate different things, whether they be bullish or bearish candlesticks, and we also need to look at where they occur in the trend. That gives us some clues as to what to expect as well. You can have the same exact candlestick shape at the top of an uptrend or the bottom of a downtrend, and it means the exact opposite thing. So it's important to look at the whole picture here. And just for going into some of the details right now, we can see what we have here is this is a doji candlestick. The high is the top of the wick. The low is the bottom of the wick. And you can see the open and the close were at the same price. So there's no real body of the candlestick because there's no trading range in between that open and the close. And you can see some other candlesticks here. We've got this green candlestick. We know the open was the real body of the candlestick. The close was the top of the real body. And you can see the lack of an upper wick. So that shows us that we closed fairly close to the high of the day. And that's a strong close because there wasn't much profit taking off of the high. And you can see here, the candlesticks that have a longer upper wick, that does show profit taking because you have the price hitting the high of the day, and then by the time we close, it's a little bit lower. So that can tell you when there's profit taking. It can also tell you when bulls are buying the dip. Look at this candlestick back here. You see the long lower wick and the small real body. So we can see the price took a big drop at some point during the day. We hit the low, which is the low of the wick, and then the bulls bought that dip and closed it up towards the real body here, and that shows you that bulls are buying that dip, which would be interpreted as bullish. The bigger the lower wick, you know, the more buying off of the low of the day. The bigger the upper wick, you know, the more profit taking from the high of the day. So those are just some basic fundamentals. It's very important to look at the candlestick shapes and determine or learn what they mean. And there are, like I said, there's dozens and dozens of candlestick names. I don't think the names are as important as long as you know what the shape of the candlestick is telling you in terms of profit taking or bulls buying the dip, whether it's a strong or weak candlestick. Like we can see here, this is almost a red Marubozu candlestick, which is when the open is pretty much the high of the day and the close is the low of the day. And that shows you that the bears controlled the vast majority of the trading day, and it's a very bearish candlestick. That's opposed to a green Marubozu candlestick, where the open is the low of the day, the close is the high of the day, and it shows the bulls were in full control. And we also have other indicators that we're going to go into a little bit more in depth here later in the video. We'll look at the RSI. These bars down here indicate volume. And you can see when you put your cursor over a candlestick, it tells you the volume, it tells you the open, the close, the high, and the low. So if you're not seeing any of the trading going on in a particular day, you can pretty much get the most important information that you need as a bit of a recap as to what went on that day just by the candlestick shape and looking at the wicks and the real bodies and the volume. Speaking of volume, we're going to be looking at it a little bit more in depth here along with moving averages, and both of these are tools that traders want to have in their tool belt, and I refer to them as pieces of the puzzle that give us a greater picture, a bigger picture of what is going on. So the volume is the amount of shares traded in a given time period. And if we're on the daily chart, we know that each candlestick's volume represents one total day's worth of shares traded. And if it's the weekly chart, it's one total week, so on and so forth. So it's important to distinguish between dollar volume and just volume in general. Volume is the amount of shares, the number. But if we take a stock, for example, a $1 stock, and we see 1 million shares traded, we know that's $1 million of volume. And if we compare it to a $20 stock that sees 500,000 shares traded, on the surface you would say, well, there's more volume in the dollar stock. But if you multiply the share price by the amount of shares traded, the volume, you get the dollar volume. So it would be 1 million shares on $1 stock would give you $1 million of volume, and 500,000 shares on a $20 stock would give you $10 million of volume. So it's important to have that metric for comparing different stocks that might be priced at different levels, because the share number alone does not give us that dollar volume that is very important. So the volume also indicates liquidity and many other clues about trading action. It is very essential that we have liquidity, because with liquidity becomes volatility and trading opportunity. So liquidity is the amount of volume that we see, and if you see a stock that has very low liquidity, it jumps around, it makes charting harder, and it makes trading opportunity harder as well. So consistent volume and liquidity is absolutely important when you're making trading or investing decisions. There's rules of thumb with volume. One of those for the bulls is the bulls always want to see increasing bullish volume on an uptrend. That shows strength. I refer to volume as almost like a proof indicator. You can see a bullish move occur, and if you see decreasing bullish volume on that move to the upside, that would have me questioning the strength behind that move and wondering if it's going to be a bit of a fake out or if the bulls are going to be able to keep up that momentum. But if you see increasing bullish volume on an uptrend, you know the volume is backing up the price action and the bulls are strong. There's also indication that you can get from volume on a breakout. When you see a stock range tighten and the trading range get tighter and tighter, it's very often accompanied by decreasing volume. And then once that break occurs from the tightening range, it's accompanied by a spike in volume, and that spike in volume can give you a bit of a heads up that the trading range is about to break, volatility and price action movement is about to pick up. There's other things we can tell. If we're in an uptrend and we see a couple red days start to form and it's on increasing bearish volume, that's a heads up to the bulls that the trend might be changing to favor the bears. Now, conversely, if we're in an uptrend and we see decreasing bearish volume on a pullback, that's exactly what the bulls want to see. That's normal, healthy consolidation. We know no stock is just going to go straight up. So in uptrends, we have higher lows and higher highs, and it's important that we see decreasing bearish volume on those pullbacks of consolidation. That gives confidence to the bulls that they are still in control of the trend and the price is still going to go up. There's also some other information. Volume climaxes often occur at the top of an uptrend or the bottom of a downtrend, and that signals a trend reversal. If you see a big spike in volume and a lot of price action around the top of an uptrend or the bottom of a downtrend, we can know to start looking in the other direction. So volume is absolutely an essential indicator to be utilizing. If I were limited on the amount of indicators I could use, volume would absolutely be at the top of the list for those that I would choose to keep on my chart. On to moving averages now, and moving averages are another essential piece of the puzzle because they tell us what the average price was over a certain period of time, and they also act as support and resistance, as we will show here in just a minute. So there's two different kinds of moving averages. There's simple moving averages, and then there's exponential moving averages. The simple moving average is just the calculation of the average price on whatever time frame you're looking at. Let's say we're looking at the daily chart. So the 20-day moving average would be the average closing price of the previous 20 days of action. If we're on the hourly chart, the 20-period moving average is the average of the last closes of the 20 candlesticks on the hourly chart. So it's the close of the candlesticks that get factored into the moving averages, and the time period lets us know how far back that goes. Exponential moving averages are calculated a bit differently. It's a little bit more complex of an equation, and we're going to skip that for now. We're not going to go too in-depth. Just a quick fact is exponential moving averages react quicker to the price. So the 20 EMA would act quicker to the changes in prices than an SMA would. But we want to keep it simple here. This is an intro lesson, so we're going to stick with the simple moving averages as their name so appropriately is named. So this is how they are written. MA20, that's the simple moving average, 20 period. If it were MA200, we know it's the 200 period moving average. And again, whatever your time frame is going to determine whether that's the 20-day moving average, 20-week moving average, so on and so forth. So like I said, they act as support and resistance. When the price is trading above a moving average, that moving average is support. And when the price is below the moving average, that moving average is resistance. In terms of the length of time factored in, the longer it is, generally it's stronger. So the 200-day moving average is a more significant price level than the 20-day moving average would be. So if we're above the 20-day and the 200-day moving averages, I would say that the 200-day moving average is a stronger support level than the 20-day moving average is, and that's because there's more time, more price action factored into that calculation. It's a bit of a self-fulfilling prophecy, and what that means is the more people that are utilizing technical analysis and looking at these moving averages on a chart, the more it's going to come into play. If we have thousands of traders looking at the 200-day moving average support, we can anticipate it's going to be more likely than not that when the price hits that level, it's going to act as support because traders are anticipating it to act as support, and they're going to be placing their buys at that level. So the more people that utilize technical analysis, the more that this self-fulfilling prophecy is going to play out. And as we've seen over the past decade, the trend is very clear. Technical analysis is going nowhere, and it's only going to be growing in popularity over the next decade, in my opinion. Now we're going to look at an example of the chart and what the volume and moving averages are telling us. Back to our trusty S&P 500 daily chart here. And we can see a bunch of lines here, a bunch of different colored lines, and the key up here tells us what time frame they're looking at. I suggest when you are creating your charts to always use the same colors so you get familiar with them depending on whatever time frame you're on. So I always know that the red line is my 200-day moving average. If I'm on the weekly, it's the 200-week moving average, and just getting familiar so you can look here at your chart and know what the colors represent without having to keep reading the key and double check. And obviously the more that you look at these charts and the more you use them, that's going to become ingrained in your memory. But as of right now, we can see I do have a couple exponential moving averages here, and you can see they're a lot tighter to the price action. But like I said, we're going to skip those for now. Look at this 20-day moving average support. So this level held as support for almost 2 months. The longer that a moving average holds as support, the more significant it is once that level is lost. So we can see it acted as support here. This was just 2 days ago on Thursday where the price bounced off that moving average support. And although we dipped below it, it's the close of the candlesticks that's important to letting us know if the moving average is holding as support or if it is lost and then flips to resistance. So although we dipped below that moving average, we closed above it, maintaining that level as support. Now the next day, we dipped below it again, and now we closed below it. So this moving average, which has been support for 2 months because the price is trading above it, is now resistance heading into next week because we closed the day below that moving average, and it is now resistance. So former support, now resistance. And another clue that we can gain here, look at the volume. We see an increase in volume favoring the bears because it's another lower high and lower low compared to the previous day of action. It's a red day, it's a loss of support, and it's an increase in bearish volume. We look back here to the reaction in November to the election. Look at the volume, high bull volume, increasing bull volume on that breakout. And that's how we knew that move was for real. It wasn't just a knee-jerk reaction to the election. The volume told us that the move by the bulls was strong. And like I said, it's proof that the price action is going in the right direction because the volume is backing that up. And in terms of a pullback, the bears or the bulls always want to see a decrease in bearish volume on consolidation. And we don't have that right now. We've got an increase in bearish volume. So we're going to be looking to the downside in the short term because the bears have assumed a bit of control now that this moving average has become resistance. In terms of other moving averages, I can see this blue line is the 50-day. I don't even have to look here because the blue line has been my 50-period moving average for years. So I know that that is instantly what I'm going to be looking at when it's a blue line. And the price is still above that level, so that moving average is still support. So I know that as the price approaches this blue line, we can anticipate it to act as support. Look back here in late September, the price was below it, and this blue line, the 50-day moving average resistance, was acting as resistance. We see the price get above it, but unable to close above it. We attempted again, we got above it, unable to close the day above it, so it stays resistance. Again, it's the close of the candlestick that is important. And then we saw some bearish action and downside over the next 3 weeks due to the inability to get over moving average resistance. On to trends now, and like I said, even if you are a long-term investor with no interest in short-term trading, knowing overall trends is essential. And if you have enough practice, you can look at a chart, and in 10 seconds, you can know if the chart is in an uptrend or a downtrend. So how do we distinguish the prevailing direction of a stock or a commodity? The components of a trend are the higher lows and higher highs. We all know the familiar stair-step pattern, which shows higher lows and higher highs in an uptrend. And like I said, nothing goes straight up or straight down. So it's important to distinguish that even though the stock does go down for certain periods, as long as it's progressing with higher lows and higher highs, that is the definition of an uptrend. And inversely, a downtrend is lower highs and lower lows. It's important to distinguish that the time frame that you are looking at can determine whether you're seeing an uptrend or a downtrend. So a stock can be in a long-term uptrend on the weekly time frame over multiple years, but if you're just looking at a 3-month daily chart, and that means it's a daily chart over a 3-month period of time, that can be in a clear downtrend, but then you need to zoom out to the weekly chart and see that the long-term trend is still very clearly bullish. That can happen many times, so it's important to gather a lot of information by looking at different time frames, and depending on what your game plan is, that's going to depend on how much weight you put in certain time frames. So like I said, a long-term investor, they're going to be interested in the monthly, the weekly, maybe the daily chart, but not as important as the weekly and longer term charts if you're looking years out. If you're a day trader, the weekly chart is not nearly as important as the hourly chart because that is much shorter time frames and you're interested with what's going on right now, not what's going on in the year-long outlook of the stock. So it's important to know what the overall trend is because when you're trading, your game plan is going to be a little bit different depending on whether you're trading with the trend or against it. Now, we know the saying that the trend is your friend and you want to be trading with the trend. That is absolutely the truth, and it's a lot easier to trade with the trend. But there are certainly opportunities trading against the trend. But whenever you're trading against the trend, the duration of the trade is going to be shorter. So we have scenarios where we see an overreaction in the market, we see fear and panic, and a stock completely drops. And we know it's clearly in a downtrend, the bears are in control, but if we get some indications from the indicators like the RSI and volume, and we have moving average support being approached, we know that we can look for a short-term oversold bounce, and we know that it's going to be a short-term trade because we're going against the trend. So if you're going against the trend, duration of the trades are shorter. If you're trading with the trend, the trade can play out over a lot longer period of time because you know you have price history in your favor. So let's give an example of each of these, trading with the trend and trading against the trend. So back to the S&P 500 daily chart where each candlestick represents one trading day worth of action. This is a 3-month chart, and you can see we are clearly in an uptrend. We had a pullback to start October, but we bounced, look where we bounced, right off the 200-day moving average support. So that moving average acting as support, and look at the reaction the bulls had from that level. We had a big bull move. There's our higher high. We consolidated, normal healthy consolidation for short-term periods. We formed a higher low, continuation with a higher high, and now we're consolidating again. So on the daily chart, we're going to remain in an uptrend as long as we form a higher low on this pullback that is higher compared to this low. So this low was at 2187. I'm rounding here, 2187, and we could pull all the way back to 2188 and it's still a higher low and the uptrend would still be intact. Looking at the weekly time frame, where each candlestick is 1 week of action, and this is going over 1 year and 3 months, we can see we are also very clearly in an uptrend here, where we have our lows, we have our higher lows and higher highs as the bulls progress here, and we can see that pretty much every time there is panic, the bulls buy the dip. Here's our Brexit panic, and bulls bought the dip and saw a big higher high. Then we had the election panic with Trump winning surprisingly, and we've got a higher high here again. So the uptrend is very clear, and we are going to remain in an uptrend as long as we consolidate and form a higher low compared to the low of the most recent pullback here, 2083, which was right before the election. So trading with the trend, we can see that on consolidation, we should be looking bullish because historically, in all of 2016, every pullback has been bought by the bulls and led to higher highs. So trading with the trend of the S&P 500 would mean looking for bullish entries when we have a pullback. Now, conversely, if you were trading against the trend, you would be looking for short-term pullbacks. You can see here these red weeks. We have 3 red weeks before the bulls show back up, 3 red weeks. So you can see that the periods of pullback are shorter term compared to the periods of bullish activity, which is going with the overall trend. So if I were playing anything bearish in the S&P 500, I would know to keep my trading time frame short because I'm going against the grain in terms of the overall trend. Let's now look at some downtrends. Here is an example of a downtrend. It's GWPH on the daily time frame, and we can see our high back here in early October. We pulled back significantly. We established our low, a bounce attempt. It's still a lower high. We look back at the price action, 137.88, and the high we hit here was 134.51. So still a lower high. We pulled back and we hit a lower low. The low of this consolidation was 110.65, and we broke that level, hitting down to 107.10. So there's a clear lower high and a lower low, another lower high and a tight trading range. So you look at this daily chart and you say, okay, GWPH is in a downtrend, and that is true on this daily chart, but it's important to get all the information, look at lots of different time frames to put the pieces of the puzzle together. And we look at the weekly chart and say, oh man, GWPH is actually in a long-term bullish uptrend since back in March. Very clear higher lows and higher highs progressing up for the bulls, and we actually hit an all-time high back here in October. So we're seeing the pullback from that all-time high, and it might be a little bit deceiving as we're zoomed in and only focused here. And if this was the only time frame we used, the daily 3-month chart, it would be essentially having blinders on and missing the overall bigger picture that we can see by zooming out. So we know that the bulls are in control of the longer term time frame. So while we may be looking bearish on the daily chart, we can anticipate that it is more likely than not that the bulls will show up to keep this weekly uptrend intact over the long term. So we might be looking for shorter term trades if we are looking bearish on this daily time frame. And that being said, we can also be looking for longer term bullish entries, anticipating that the bulls are going to show up again as they have been doing all year after periods of consolidation.
Hi guys, Jason here, partner with TheChartGuys.com, and I'm joining Dan today to talk to you a little bit about indicators. So by now in your technical analysis career, you've probably come across some charts with lines you might not yet understand. And those are very likely just going to be different forms of chart indicators. So right off the start, indicators are just a complex way of representing market data. They take price information, they rework it, manipulate it, change it, and they find new and interesting ways to visualize it. And these changes are all due to mathematical calculations that have different goals, but at the end of the day, they're all using the same price information that we see in our candlestick charts. There's a few very important items that I want to express regarding indicators. First, indicators are descriptive. They are not predictive. They take old data over different periods of time, they average it, they calculate it, they change it, and they use that data and represent it in new forms. Because of that, indicators tell us what has already happened, not what is going to happen. Secondly, indicators are always lagging. Like I said, they use previous market data, sometimes up to 2 weeks old or 14 periods, and they take information about what has happened and they use that to attempt to forecast, if you will, what's going to happen in the market. So in that respect, it's a lot like trying to predict the weather. We take the current set of conditions, we compare that to the historical set of experiences that we have in similar conditions, and we attempt to predict what is going to happen based off what has happened previously. Indicators themselves have a very wide range of complexity. You can have a single line indicator that simply is a 3-day average. So for example, if we have 3 days of price action where our closing price is $5, $10, and $15, if we have a 3-day moving average of that price, or our 3MA is going to be $10. And there are countless indicators that are available, literally hundreds of them, and new indicators are being developed all of the time. We have MACD, we've got RSI that we're going to look into, we've got the no sure thing, we've stochastics, we've got fast stochastics, slow stochastics, balance of power, average directional index, average true range. There is literally hundreds of these indicators that people have developed that all use price action, price history, and they try and change it in a new way to give them the edge and give them a competitive aspect in the market. So really the take-home lesson that I want to express in these last few minutes is that indicators are just a really complicated way of showing you things that you can already see. The same data is being used and it's being calculated and presented for you. So if we're going to be using indicators, I feel that it's critically important to understand how indicators are derived, how the information is collected, manipulated, and presented, and really having a solid grasp on what is happening behind the scenes before we start utilizing indicators in our daily trading. I think you'll encounter a lot of people who use the MACD who really have no clue how it functions or what it does. They're simply looking for lines, crossing lines, without understanding the math that's going on. So with that in mind, what I'd like to do is take a look at the RSI indicator. We're going to investigate what it is, what it means, and then we're going to get into the real meat and potatoes of it and take a look at the calculation that's happening that derives our RSI value. So what is the RSI? The RSI is termed the relative strength index, and it is an indicator that measures relative velocity of price movement to preceding. So it's an indicator that tells you essentially if a particular stock is overbought or oversold. And it does this by presenting a value that is based on a 0 to 100 scale, where 100 is an overbought condition and 0 is an oversold condition. And it takes 14 periods of price information. So if you're looking at a daily chart, it's going to use the last 14 days of information. If you're looking at a 5-minute chart, it's going to be using the last 5-minute. It's going to be using the last 14 5-minute periods in its calculation. So this value, represented as anything between 0 and 100, is supposed to tell us if something's overbought or oversold. Now, how can we use something if we don't really understand what is happening? And that's why we're going to look at the math, so that you can get a foundational understanding of what's happening in all indicators, not just the RSI. Like as I said, we're taking price information and we're changing it, and now we're going to learn how it's changed for the RSI in particular. So now we're going to look at the actual RSI calculation. What's happening behind the scenes gives us our value on the 0 to 100 scale. So when we're looking at the RSI, there is one major calculation, a sub-calculation that has two components with two different calculations that contribute data to the overall data set. So we'll start at the very top and we'll look at our major calculation, and that is relative strength index equals 100 minus 100 over 1 plus the RS, where RS is your relative strength. So to complete this calculation, we need to understand what relative strength is, and that is the average gain over average loss. Now the RSI is a 14-period momentum indicator, meaning we use 14 days worth of data if we're looking at a daily chart. So over here on the left of the screen, we can see that we have 33 days worth of data that we're using for our calculations. And because we are using the 14 periods, we need to have at least 14 days to start our calculation. So the RS is actually two different components to its calculation. The very first one is the sum of gains over the last 14 periods divided by 14 to give average, or in the case of losses, it's the sum of losses over the past 14 periods divided by 14 to give you your average. Now we look over here at our average gain column. We click on our first value for average gains. We can see that it is a collection of all of the gains in the previous 14 periods that are summed and averaged to 24. Likewise, losses in red here are collected, averaged, and represented. And then our RSI is simply our average gains divided by our average losses, resulting in 2.39. Now that's for the very first set of data, for the first representative value of our RS. After that, while we still incorporate the 14-day average, we don't need 14 periods of data because it's already been incorporated to our first average gain, average loss value. So what happens now is the calculation changes from sum of gains over the last 14 periods divided by 14 to a new calculation, which takes our previous average gain times 13 plus the current gain over 14. Now that probably sounds confusing, and it is. So we'll take a look at exactly what's going on there. So average gain, in this case, we had all 14 periods summed averaged. Now when we go to our next data set, we're not going to be using that system anymore. We're going to be using the second component here, and we can actually see that what we do is we take that 0.24 value, which we know incorporates that 14-day data set, and the newest gain, which in this case is nothing, and because it's nothing, our value decreases. Because we did take a loss on that day, we can see that our average loss increases, and our RS changes because of that. So we've sort of established what the RS is as a basic value, and we can see that as our average gains increase and decrease, our RS changes and moves up and down. Our RSI, the major component of this calculation, takes that information and uses it for its calculation. So if we look at this value of 70.53 and we go up here to our Excel calculation, if we ignore the other Excel magic that's happening here, we can see that RSI is 100 minus 100 divided by 1 plus J17, which in this case represents that day's RS value. Now, for those of you who aren't strong in math, and I am certainly not strong in math, a lot of this can be really confusing. And these values that we see for RSI constantly change because new data comes in all the time, right? Every day and every period we see new changes, new prices in RS, and because of that, changes in RSI. And our RSI values, we can see in this chart here, changes in correspondence to our RS value. Now, the goal of what I was trying to do here today was to show you that even a basic indicator, a single line, in the case of the RSI, has a very complex mathematical schema behind it. And for me personally, in order to understand how an indicator works, I feel that I need to investigate what's happening behind the scenes. I need to have a grasp on the fundamentals of that indicator, and I need to know what that value actually represents. So if you're going to be using indicators, I really encourage you to at least spend a little bit of time in your foundational studies to go into the math, look at what's happening with an indicator, where is the value coming from, what components are being combined, manipulated, and represented, and what are you actually looking at a screen when you see a red line cross a black line. What does it mean? What does the data come from? And how can you use it? And once you have at least even a foundational understanding of the mathematics behind your indicators, you are going to be so far ahead of your peers who haven't spent the time, who haven't put the effort into study, and who ultimately will be coming to you for knowledge because you have a grasp on what your indicator means and what it is telling you about the price action. So I hope this was helpful. That was a really quick introduction. There are many more videos that we have regarding indicators, and I hope to keep making them in the future. So thank you for checking out our video, and we'll go back to Dan.
So back now to the psychology aspect and how human emotion is shown on these charts. It's the shape of the candlesticks combined with these other indicators like the RSI that can give us overbought and oversold conditions. And you're going to be seeing dozens and dozens of indicators out there. And it's certainly worth exploring and finding out which ones you like best. But again, it's important to not get overwhelmed. It's important to focus on one at a time and look a little bit more in depth and take it slow. Make sure you're absorbing the information. The last thing you want to do is try and watch 10 hours of video in a day because a lot of that information is not going to be retained. But looking at these charts and giving the chart a voice, so to speak, what are these candlesticks telling us? If we see a long upper wick at the top of an uptrend with some high volume, we know there's a lot of profit taking, and we can anticipate that the bears are going to start to show up, and we're going to see normal healthy consolidation after a strong move to the upside. The volume and the wicks are really nice indications together to tell us what is going on, as is the positioning on the trend. That's important. Like I said earlier, the same candlestick shape, depending on where it occurs on the trend, can tell you completely different things. So here's an example of that doji candlestick, and again, that's the candlestick that looks like a cross, where you have the high and the low, but the open and the close are at the same level. So what that basically tells you is indecision. It shows the bulls controlling part of the day, the bears controlling part of the day, but the open and the close was about the same. So it's pretty much, going back to the samurai terminology, it's an even battle. Both sides battled evenly, and we closed at the same price that we opened. Now, if that price, or if that candlestick, the doji, occurs at the top of an uptrend, that is a bearish reversal candlestick because it shows indecision. It shows the bulls unable to continue to push higher, and it has us starting to look for some pullback. If it occurs at the bottom of a downtrend, that indecision doji tells us the bears are tiring, the bulls are beginning to show up, and it has us looking for some upside. And if it occurs in the middle, if it's not really at the clear point of an uptrend or a downtrend, it just shows us straight up indecision with neither the bulls or the bears knowing which direction we're heading next, and it shows an even battle. So that's just one example. Again, there are dozens and dozens of these candlestick shapes. It's worth getting to know them and getting to know what they are telling us by where they are positioned on the chart. So this is a very, very brief introduction to technical analysis. It is the tippity top of the iceberg. We at the Chart Guys have a 5-hour, 6-hour course that is a next step going forward. Entries and exits and knowing how to time them with your trades. We also go over a bunch of the indicators much more in depth, and really just a more in-depth grasp on how things are utilized with charts for trading, but definitely worth exploring further. This is step one, dipping the toe into the ocean, like I said, and that's a pretty good analogy because the amount of information that you can find out there on technical analysis is extremely overwhelming. It's important to stay focused and motivated to work towards your path towards success and be able to utilize this information for the next few decades, for your entire life. It's a very comforting feeling to know that retirement is not the end of income if you can utilize charts to make good trading or investing long-term decisions. I appreciate you watching. Feel free to ask any questions. We'd be happy to answer them. I hope you have a wonderful day.